Well, good morning, good evening, good afternoon to all of you colleagues and friends that are joining us in this Andrew Crockett Memorial Lecture. As you well know, this is our biannual event inaugurated by the BIS in 2013 to commemorate Sir Andrew Crockett, the bank's general manager from 1994 to 2003. And well, of course, this was due to the fact that Andrew was a pioneer in the field of central banking and financial stability. And with these lectures, we remember his very important contributions, exploring the frontiers of policy today. You will note that we are live streaming the whole event on the BIS public website and also recording it for viewing later. Our lecturer this year is Mark Carney. And well, of course, if the following phrase applies to somebody, is to Mark, which is Mark really doesn't need an introduction. You all know about his stellar role as a governor of Central Bank of Canada and also of the Bank of England. And he chaired the Financial Stability Board in the crucial period from 2011 to 2018, overseeing the post-Great Financial Crisis reform agenda with great skill and diplomacy, I would add. Here at the BIS, we are quite indebted to him because he served, well, obviously as participant, as board member, he was even the chairman of the audit committee, which takes a lot. And then he was also chairman of the ECC and the Global Economy Meeting. Mark has been invited to give this lecture because of his insights, because of his wisdom, because of his experience. Certainly, we wanted to have him here in Basel because one of the we owe you, Mark, is that we never managed to give you an appropriate farewell. We never managed to have you here for a very last time. So that still will have to come into the future. Another very interesting aspect about Mark is that after him moving on from central banking, he has continued with another central aspects of his character and his career, and is his devotion to public policy. And now, of course, he's providing major insights and leadership in issues related to climate crisis as the UN Special Envoy for Climate Action and Finance. Today, Mark will draw on this rich experience in public policy that has provided him with deep thoughts on how policymakers can best promote the public good. He will deliver a very timely lecture on the art of central banking in a centrifugal world. Mark has already made waves with new ideas for money in the digital world. In August 2019, in a now famous speech at Jackson Hole, he asked whether the official sector should play their part in providing new forms of cross-border payments to help smooth the transition to a multipolar monetary system. Today, he will be talking about how the societal demands on money are changing in the digital age. He will discuss how central banks can continue to preserve the public good in an era of cryptocurrencies, stable coins, the entry of big tech into finance, and central bank digital currencies. These are critical issues for central banks that go to the heart of our mandates for stability and integrity in the monetary system, and the more so as we recover from the pandemic. Mark, we very much look forward to your thoughts. Immediately after Mark's lecture, we have a high-level lineup of panelists with Ignacio Visco, Elvira Nebulina, Ravi Menon, and John Williams. And afterwards, we'll have a Q&A, and we also will hear from Mark. So without further ado, let me give now the floor to Mark. Please, Mark.
Thank you very much, Agustín. It is a great honor to be here virtually to give this Andrew Crockett lecture. And may I say that very much inspired by the interaction with my colleagues over the course of the years, but accelerated by the work that you all have been doing and the BIS has been leading through the Innovation Hub on these sets of issues. So what follows is a bit of a now outsider's perspective on some of these issues. And as an outsider, I'm going to I'll try and provide a little substance, but more, I have to supplement it with some pictures. And then I'm very, very interested, as all of you are, in hearing from Ravi and Elvira, John, and Ignacio, and also from my the fellow central bankers, former central bankers' perspectives and questions. So, with that, let me begin. And as you referenced, Agustín, what I'd like to do is to try to paint a picture of central banks a decade out. And I choose that metaphor of art because central banking is an art as well as a science. And the value of money is not simply the product of formulas, rules, or algorithms. As a social convention, money is more an art grounded in the values of trust, resilience, dynamism, solidarity, and sustainability. And central banks are its curator. The role of central banks is being challenged in the wake of intensifying centrifugal forces, including an increasingly multipolar global economy, the growing weight of market-based finance, and, as you mentioned, my primary focus today, the emergence of crypto assets and distributed finance. In response to these developments, I'm going to suggest that central banks should pursue a deliberate, values-based strategy to deliver their core mandates of monetary and financial stability. Central banks will have to look very different to support the resilience that our economies need, while helping to realize the promise of the fourth industrial revolution. Now, turning a bit to the art of money, the physical manifestations of the art of money are found on banknotes. Their history tells the moral of this lecture, namely that most private monetary innovations fail. But there are a few that change the nature of money for good, and they do so because they serve the evolving nature of commerce and, critically, because they establish an effective relationship with public money. The first known banknotes were developed in the 7th century in China to allow merchants to avoid carrying heavy copper coins for large transactions. After Marco Polo introduced the concept to Europe in the 13th century, banknotes became increasingly common in the 17th and 18th centuries. Private banknotes, like other private forms of money through the ages, were prone to debasement, including, as the BIS has demonstrated, the earliest stablecoin, the Bank of Amsterdam. In the United Kingdom during the 18th and 19th centuries, the failure of note-issuing banks were commonplace. Consider the contrasting fortunes of the Austen siblings. The celebrated author, Jane Austen, currently graces the UK £10 note. Her brother Henry was also on a banknote. He had set up a bank with interests in Hampshire and London at a time when many banks were small and local and issued their own banknotes. Unfortunately, although Jane Austen wrote that, I quote, "Once a man has his name in a banking house, he rolls in money," that wasn't the case for her brother Henry. Unwise lending led to the collapse of his bank and his fortunes, and depositors, including Jane Austen herself, were left out of pocket. In the 19th century United States, a similar tale was taken to extremes. At the apex of the wildcat era of banking, private banknotes represented almost 90% of notes in circulation. They were of variable quality and they traded at different rates. As James Bullard has cautioned, this period of highly inefficient, unregulated currency competition serves as a warning of the potential problems if the most recent explosion of private monies is allowed to go mainstream. Before heeding this warning, let me turn back to the art of money. A few years ago, the characters on the Bank of England's 20-pound note transitioned from Adam Smith to J.W.M. Turner, or from economist to artist. Amongst his many contributions to economic thought, Smith defined the three functions of money, functions that are now being unbundled. Smith also underscored that economic capital cannot be divorced from its social twin, just as the value of money cannot be separated from the values that underpin it. Of the many Turner masterworks that could have graced the 20-pound note, the Bank of England chose The Fighting Temeraire. This painting depicts the end of the age of sail and the rise of the age of steam, a technological breakthrough with widespread impacts on commerce, on society, and even on geopolitics. The final banknote transition during my time as governor captured an even greater technological transformation, as the bank replaced the engineering heroes of the Industrial Revolution, Boulton and Watt, with Alan Turing. Of course, Turing's contributions included path-breaking wartime cryptography, as well as being the father of modern computing and artificial intelligence, three technologies that are now fundamentally changing the nature of money. But it was a different monetary innovation, fractional reserve banking, that financed the Industrial Revolution that Boulton and Watt had helped unleash. This new form of banking broadened the efficiencies of Smith's invisible hand at the price of risk to financial stability. In order to maintain the value of money, central banks had to become increasingly active as supervisors of private banks and in extremis as their lenders of last resort. Based on the experience of private banks issuing notes based on the good name of those private banks, most observers, including Milton Friedman, agree that laissez-faire is not a good foundation for sound money. And so there have been two approaches to maintaining public confidence in money. The first is to back by a commodity, principally gold, and the second is to back by institutions led by independent and accountable central banks. Which brings me back for a moment to art. A few years ago, as he reflected on the 5,500 tons of gold lying in the Bank of England's vaults, the sculptor Antony Gormley thought of the futility. The raw ore scraped from the depths of the four corners of the earth, then refined, assayed, and shipped across oceans to be brought through the Bank of England's gates, only to be buried once again. Gormley conceived of returning both the gold and the observer to their roots by creating a sculpture made from the gold in situ in the vaults. I put it to him that it was unlikely to be seen given security requirements, but he was relaxed because he understood the true nature of value. It would add to the irony, with the value in the creation, in the act, not the witness. The gold at the Bank of England is a vestige of a bygone era when gold backed money and an even earlier time when gold was money. And the story of how gold lost its crown reveals how the values underpinning money reflect those of society, a lesson which should guide determinations of the future of money. For a time, confidence in money can be supported by a simple rule such as the strict convertibility of the gold standard. But credibility and trust cannot be maintained without institutional backing and political support. And this in turn requires public understanding, built through transparency and accountability. And it requires public consent, grounded in solidarity, including in the fair sharing of the burdens of economic adjustment. The value of money is based on shared values. There have always been incentives to relax temporarily monetary strictures and disciplines. In the absence of a strong social consensus, these pressures eventually overwhelm. Trust in the gold standard could only be maintained as long as the social, political, and economic conditions resembled those when it, that is, the gold standard, came into being. By the end of the 19th century, global economic power was becoming more dispersed, making the gold standard tougher to manage. As financial systems grew more complex, the self-equilibrating nature of the system also weakened. And central banks were increasingly conflicted between their responsibilities as lenders of last resort to growing fractional reserve banking systems and their commitments to convertibility. Political pressures began to emerge as suffrage was extended, labor began to organize, and political parties representing the working classes gained popularity. A single-minded focus on convertibility over the impacts on the domestic economy, particularly employment and wages, became increasingly untenable. This undermined the credibility of the system, underscoring that the gold standard was, and I quote Barry Eichengreen, a socially constructed institution whose viability hinged on the context within which it operated. As we know, the system finally broke down with World War I, and efforts to resurrect it ultimately failed because the changes that had been underway before the war had only accelerated. And they failed most fundamentally because the values of the gold standard had become inconsistent with those of society. And so it is that modern money is backed by a series of institutions, mostly housed in central banks. Its value rests on confidence. The value of money requires not just the belief of the public at a point in time, but critically the consent of the public at all times. That dictates not just what the central bank does to maintain the value of money, but how it does it. When it comes to money, the consent and trust of the public must be nurtured and continually maintained. Central banks have a primordial responsibility to act as the guarantors of trust and confidence in money, given their status as monopoly issuers of the currency. This gives them control over the quantity of money and interest rates, monetary policy. An essential part of financial stability policy, acting as lenders of last resort, also falls to them. And most central banks are responsible for preventing the buildup of vulnerabilities in the first place. That requires maintaining the safety and soundness of banks, and it means safeguarding the stability and resilience of the financial system as a whole by managing the financial cycle and addressing structural risks in financial institutions, in markets, and in payment systems. And so it is that, although the vast majority of money in circulation is private money, it's anchored in public money. Commercial banks hold accounts at their central bank. They settle transactions electronically between themselves and central bank money, and can borrow from the central bank to meet liquidity shortfalls, including in times of stress. Systemic payments infrastructure is generally subject to similar oversight and backstops. Through trial and many errors, we found a partnership in which the private sector, namely banks, create most of the money, but in which central banks use the price of money to control the demand for money creation in order to ensure that the growth in the stock of monetized obligations is in line with what the economy can produce. We learned at great cost both that a fixed stock of money, in other words, the gold standard, is out of line with a dynamic and growing economy. And we learned that the unconstrained money creation destabilizes money itself. If on balance, people have confidence in the money they use, this is due to the credibility of this institutional framework, including the public's recognition that central banks at the core of the system are on their side. We should never take this trust for granted. The financial crisis was a reminder that in the end, that money is, to quote the words of John Cunliffe, money is, in the end, a social convention that can be very fragile under stress. Moreover, technological change is widening wealth and income inequalities. And through social media, technological change is contributing to the polarization of public opinion. To many people, the necessary monetary stimulus of the past decade is perceived to have widened wealth inequalities, putting further pressure on public consent. And into this heady mix comes competition from a burgeoning array of new private currencies that threaten to disrupt monetary and financial stability. Money can change because of fundamentally transformative innovations, including advances in cryptography and artificial intelligence, as well as the powerful network effects in social media. But most fundamentally, money needs to change to serve the new economy. Our economies are now undergoing two great rewirings, the digital revolution and the sustainable transformation. Economic relationships are reorganizing into distributed peer-to-peer connections across powerful networks, revolutionizing how we consume, we work, and communicate. As commerce moves online, work is dispersing across geographies. In parallel, and at the 11th hour, the sustainable revolution has finally begun in earnest. The transition to a net zero economy will involve every region, every sector, and every company. The scale of investment required is enormous, with estimates of energy infrastructure investment ranging from $3.5 to $5 trillion every year for decades, or more than double the current rate. Investment on this scale can only come from mainstreaming private finance, underscoring that in the new financial system, every decision must take climate change into account. The climate transition will require enormous and rapid structural change. And if it's similar to previous periods of profound technological innovation, the fourth industrial revolution will lead to a long period of difficult adjustment and rising inequality, long before the benefits of increased productivity, wages, and jobs are widely felt. Adding to this sense of disruption, the COVID crisis has accelerated these transformations. During times of great change, the relative weight that societies place on certain core values, namely resilience, dynamism, solidarity, and sustainability, is revealed. And history teaches that realizing the gains from major technological transitions eventually requires the overhaul of virtually every institution, from education to finance. So as money is unbundled and repackaged, the role of central banks will once again change fundamentally. The core role of money is to facilitate market-based exchange. Private monies spring up when there are areas where this isn't happening. Some of those innovations close gaps in the payments. Some of those innovations to close gaps in the payment system are good, such as new forms of distributed finance that drive efficiencies in security settlements, and innovations that reduce the costs of cross-border payments. Some of those innovations are bad, such as the use of cryptocurrencies like Bitcoin for ransomware, money laundering, and terrorist financing. These are gaps we never want filled. And some of the use cases of the new forms of money are truly innovative, such as emerging deployment of distributed ledger technology to track greenhouse gas emissions, green electrons, and carbon offsets, as well as the ability of NFTs to open up ownership of digital assets. And this brings me to my last banknote, one created outside a central bank, a virtual fusion of the digital and the physical, of art and money. Last week, I visited a studio where the artist Damien Hirst has created a currency in the form of 10,000 unique multiple paintings. The buyers have the option of taking delivery of either the physical painting or an NFT of that painting, but not both. ownership can be actual or virtual, and once sold, the paintings will be traded in a dedicated market. The art explores both the nature of money and money's role as a store of value and medium of exchange. While impressive in its imagination, Hirst's work is modest in its scale. Other innovations unbundle money, focusing on the means of payments roles exclusively. Those innovations target very large scale and seek to capture very new forms of value. This private money is being created to integrate payments data into data-driven services provided by technology companies. Money's role as a means of payment will be used to feed the flywheel. In this way, large technology companies could become major providers of private money. And although they may not wish to provide credit themselves, they could become central to credit intermediation as conduits for white label financial institutions, as some, including Marcus Brunemeyer and Harold James and Jean-Pierre Landau, have suggested. This could invert the hierarchy in financial services, and it will help change the nature and funding of credit intermediation. It'll have ramifications for domestic regulation well beyond the payment system, and even change the structure of the international monetary and financial system. So before discussing some of those ramifications, let me step back, just make a few comments on the principles of money in a distributed age. And this new financial system, I would suggest, must meet several requirements. First, new forms of money and payments must be as resilient and trustworthy as the existing system, while offering better services to customers. And so when economic shocks hit, the new money should hold its value, monetary stability, and all institutions that touch it should remain reliable in financial stability. The money must be scalable, operationally robust to unusual events, and never prone to technical outages. The new money must be accountable and transparent by protecting privacy and preserving customer data sovereignty. Cash is anonymous, and there's an expectation that private banking details will remain private within the constraints of the laws that guard against money laundering and the financing of illicit activities. New electronic forms of money will need to define the boundary between anonymity and customer-sanctioned access to private information in order to provide improved services. Thirdly, money should be inclusive and promote solidarity. New forms of money and payments must make good on their potential to democratize financial services by dramatically lowering the cost of payments and broadening access. This means promoting competition for customer services, and that the network externalities of new forms of money should benefit the public, not the provider. Promoting solidarity means never going back to forms of money like the gold standard, where the burden of adjustment falls most heavily on one class, labor. Rather, it means taking full advantage of the fundamental stabilizing role of modern money that lifts the liquidity constraints of individuals in a downturn and of financial institutions in a crisis. The new forms of money must be operationally efficient and environmentally sustainable, with every industry undertaking fundamental transformations on the path to net zero emissions. The new monetary system should be more carbon efficient than the one it replaces. It's unthinkable that it would be dramatically worse. And finally, new forms of money must support economic dynamism by offering new services and providing cheap, efficient, and secure payments. New services include pooling data for more efficient access of small businesses to growth capital, integrating with smart contracts to improve efficiencies from finance to commercial trade, and making cross-border commerce indistinguishable from domestic activity. Against these criteria, the new forms of private money create several public policy issues. These include the potential to recreate the inefficiencies and volatility of earlier eras when there was a circulation of a host of currencies of varying quality. There are concerns over the resilience of the monetary system given operational risks in the broader crypto ecosystem. Issues with the quality of the backing of stablecoins and the risks of creating a modern Bank of Amsterdam at the heart of the payment system. There's a range of issues around anonymity, data privacy, and the financing of illicit activities. And there's the abhorrent environmental footprint of some cryptocurrencies, most notably Bitcoin, and the massive opportunity cost of solving it in a world that already needs to build the equivalent of the world's largest solar field every day by the end of this decade. It is possible to have a steady state in which both public commercial bank money and new forms of private monies circulate as media of exchange, with the private currencies facilitating transactions that would not otherwise occur. The key questions are whether these transactions are desirable, and if they are, whether they could be more effectively facilitated by public money. At a minimum, for the new system to maintain the values of sound money, central banks should continue to provide a series of public backstops. Specifically, that means securing underlying money in the form of electronic cash or the unit of account, ensuring finality of payments, providing liquidity support for scalability in times of stress, and overseeing the payment system as a whole. To the extent that there are new private monies in circulation, central banks should be as open to them as to traditional players, with equal access to key central bank facilities like real-time wholesale payment systems, the ability to place deposits, and to access short-term liquidity. The quid pro quo should be the same regulation for the same activities, irrespective of whether the provider is a bank, a non-bank financial services company, or a tech company. This would ensure that the new money is as secure, reliable, and trusted as traditional forms have become. So let me move towards a new settlement or central banking in this centrifugal world. The potential basis of this new relationship between public and private monies is well summarized by the BIS in its most recent annual report. The main components are privately provided payment interfaces or wallets that would have the relationship with the customer and provide them with value-added payment services. The central bank would provide the core ledger, and APIs would provide the connectivity between the layers. This architecture, with a CBDC with API connectivity, would be an essential backbone of an open finance environment which serves broader social objectives, including competition, innovation, and privacy. The core question is what hangs off this platform, namely, where does the private sector take over in the chain between the end user and the central bank? Wherever this line is drawn, the roles of money are unbundled into stores of value and medium of exchange. The options for drawing this line include a publicly accessible retail CBDC, wholesale CBDCs in private wallets, and private stablecoins. If, and only if, they are credibly backed, private stablecoins could be either the equivalent of Scottish banknotes, so branded by sponsor or use case, or indistinguishable to the public from other private monies. Transactions within stablecoins would be settled in real time in wallets or the native applications, and transactions across stablecoins would be settled in real time at the central bank. As is the case today, any systemic private money must link to public money at the core of the system. The ability to convert on demand private money, such as a bank deposit, into public money issued by the central bank today in the form of cash, is a foundation of confidence in money and payments. It promotes the understanding that different types of money are uniform, and it makes them substitutable. More generally, The ability to access central bank money acts as an anchor for value. The fact that holders have the right to convert their commercial bank money into public money, cash, contributes to the widely held view that it is just all the same money. This link to public money is a necessity for systemic stability, and it's a privilege for any private payment system that has it. Given the broader issues that the new money raises, from privacy to competition, authorities beyond central banks should shape the decisions about which private options get the possibility of that access, while the central bank will always be the final arbiter of who is able to draw upon it. In other words, central banks set the necessary but not sufficient conditions for access to their balance sheets. Governments weigh impacts on privacy and competition, and these considerations are relevant for the consent of the public for the system over the long term. And they should be decided ex ante to avoid lock-in. In this last regard, the apparent mismatch between the current timetables for the potential launches of CBDCs and private retail-focused stablecoins is concerning. I agree with those, such as the Riksbank, who argue that the public should have access to central bank money in the form of a retail CBDC. The risks of digital bank runs suggest some limitations on holdings of digital cash and/or differences in how they're remunerated. This will, however, dampen the disciplining effect of cash on commercial banks, though arguably the shift to greater reliance on market-based financing will more than compensate, particularly if bank resolution is a credible option. It's reasonable to expect that because it will be cheap, robust, and instantaneous, payments will be principally conducted in digital money distinct from commercial bank money. As the BIS observes, existing bank-based payment rails are expensive, even if those costs are not visible to consumers. Commercial bank money will therefore largely be used as a remunerated store of value, and this will have implications for bank funding, credit intermediation, and the oversight of market-based finance, issues to which I'll return to in a moment. But to be clear, these higher funding costs should not dissuade central banks from pursuing reforms that offer the public greater choice and better service. Banks are a means to an end, not ends in themselves, and they'll have to adapt to a much more competitive environment. Private digital payments are systemic. And any systemic payment system, private digital money is a systemic payment system. And any systemic payment system must be overseen by a central bank and have a final settlement option in public money. In this spirit, the regulatory model for stablecoins must offer equivalent protections for those for commercial bank money. And the model includes a legal claim to be paid in fiat on demand, capital requirements, liquidity requirements, eligibility for support from a central bank during a stress, and a separate backstop to compensate depositors in the event of a failure. I'd suggest that authorities should be humble about how much risk to accept in private systemic stablecoins, and they should learn from their inability to oversee money market funds through stress. There have been 2 systemic crises in money funds in little more than a decade. In baseball, it's 3 strikes and you're out. In cricket, it's only the equivalent of 1. And for systemic payment systems, 1 is too many. If that means, as it must, very rigorous oversight and rules for private stablecoins, what would then differentiate them from CBDCs? Moreover, we should be wary of path dependence and locking in existing advantages of tech companies via the payment systems. There are powerful network effects in both social networks and money. If combined, these could be mutually reinforcing. Convenience once established may be very hard to unwind in the Uberization of money. If society doesn't want to risk such lock-in, it follows that oversight will ensure that a very common basic, indistinguishable set of stablecoins run off the platforms into various wallets. And it's not clear why a single CBDC wouldn't perform better. The potential superiority of CBDCs from a public interest perspective is reinforced by the undesirability of currency competition at the heart of the system. Stablecoins have the potential to fragment the liquidity of the monetary system and to detract from the role of money as a coordination device. With respect to crypto, only the niche will survive. With limited use cases, crypto assets will, by definition, not be that valuable unless they're the winners of the coordination game of searching for extrinsic value in digital gold. Ultimately, crypto either has such extrinsic value without a use case, or has a use case as an NFT that perfects ownership, which is niche by definition in that it is non-fungible. NFTs would link to the payments ecosystem by exchangeability into CBDCs, creating an ability for new portfolios of a much wider set of intangible assets. Excuse me. Now, this is not to dismiss either NFTs or decentralized finance, quite to the contrary. Their scope of application is exceptionally broad, but it is to stress that tokens at the heart of programmable networks will have to remain just that, of token value. Value will be exchanged through CBDCs that link such networks to the broader financial system. Any native cryptocurrencies of sufficient scale will be dominated by CBDCs or very tightly regulated stablecoins for reasons of systemic stability. In sum, the most likely scenario is a two-tier system with CBDCs at the core. This would reduce the risks of digital money and leave to a more competitive private sector the consumer-facing functions, including screening, onboarding, offboarding, servicing, and the building and maintenance of technology platforms. CBDCs would enable an alternative payment rail that maintains the properties of digital bearer instruments with greater programmability and offline functionality. Now, turning to funding implications, whatever the dividing line between the public and private in the provision of new digital means of payment, the new system will entail some loss of bank funding with the unbundling of money. Lost funding will be recycled either riskily through the assets that back private stablecoins, or risklessly through the central bank. In both scenarios, the portfolio balance effect will encourage private investors out the risk spectrum. In equilibrium, the commercial banks will be funded at a higher cost and potentially with greater volatility. Banks will have to improve liquidity management policies accordingly. With banks more vulnerable to a deterioration in sentiment in wholesale funding markets, lending rates could be more volatile overall. Now, the scale of these effects is uncertain, but they underscore the importance of addressing the unfinished business of reforms to market-based finance. The growth of market-based finance in recent years has been fundamentally positive. But with more than $30 trillion of assets now held in open-ended funds that offer short-term redemptions while investing in longer-dated illiquid assets, this liquidity mismatch creates a first-mover advantage for investors that could prompt a destabilizing rush for the exits. I've included some charts that illustrate the outflows from open-ended funds, that they're indeed more sensitive to fund performance when funds hold more illiquid assets and when market conditions worsen. To reduce first-mover advantage, greater consistency is needed between the liquidity of a fund's assets and its redemption terms. To achieve this, as you've been discussing, funds should apply a pricing tool, a notice period, or a combination of both that reflects the liquidity of their underlying assets. In parallel, central banks should recognize the importance of market-based finance to the monetary system and extend access to their liquidity facilities to more systemic institutions at the heart of the new system. The central bankers, we all learned Bagehot's dictum. To avert panic, central banks should lend early and freely to solvent firms against good collateral at a high rate. Now, were it so simple, we encounter several challenges in putting Bagehot into practice. The first, of course, is whether a firm is solvent, not least because the market can be wrong about a bank's solvency longer than a bank can stay liquid. The second is reconciling discretion in emergency lending with democratic accountability. And the third challenge is that banks tend to hoard the liquidity they receive. What may look to be sufficient liquidity in aggregate can prove too little when it's asymmetrically distributed. This exacerbates market swings, which then prompt extraordinary central bank interventions, including outright purchases, which in turn create moral hazard, impair price discovery, and contribute to public perceptions that central banks will, quote, bail out the market. As market-based finance becomes more important, a lender of last resort function that serves only banks increasingly will not serve society. This suggests that central banks should widen access to their balance sheets to a broad range of participants, including asset managers. The prospect of digital currencies reinforces this imperative. Indeed, new issues will arise if tokenization takes off, potentially dramatically impacting the market structure of the T-bill market and the role of custodians. Let me make a final point about international ramifications. Now, a major advantage of CBDCs is that they can materially reduce the costs and improve the speed of cross-border payments. A potential concern that many have raised, however, is that their ease of use might exacerbate the risks of currency substitution, with negative impacts on the monetary stability, financial stability, and even fiscal revenues of vulnerable countries. The combination of account-based CBDCs and digital IDs could mitigate these risks, as the BIS has outlined, provided there is sufficient cross-border cooperation. And in this last respect, G20 efforts towards mutually recognizing national ID credentials are promising, as are multi-CBDC arrangements that make CBDCs interoperable across borders. But even if these efforts are successful, by reinforcing the role of market-based finance, the new monetary order will exacerbate risks to cross-border capital flows at a time when they need to scale dramatically to address the needs of climate change. In recent years, investment fund flows to emerging economies have accounted for around 1/3 of total portfolio flows and the vast increase in foreign lending. And these funds are particularly pro-cyclical, meaning that the shift towards market-based finance has amplified capital flows at risk to EMEs by an estimated 50% since the crisis. By 2030, this sensitivity could triple, meaning that even fast-reforming emerging markets could be running to stand still in their quest for sustainable capital flows. And all this as a consequence of the new forms of money, increases in market-based finance, and the growing asymmetry at the heart of the international monetary and financial system. These risks underscore the importance of shoring up the global financial safety net. And while there are many aspects to doing so, one issue is the absence of an international analog of liquidity support, the type of liquidity support I proposed a moment ago in the so-called holistic approach to market-based finance. A special purpose lending vehicle, the Liquidity and Sustainability Facility, could help fill this void while supporting market access at lower rates for emerging market, developing economies, and other vulnerable sovereigns. The BIS, the IMF, and central banks should examine how best to address this gap in our international architecture. After all, the structural shift in the nature of capital flows and the drivers of their volatility should not always be addressed by ad hoc use of emergency swap lines, but rather by standing facilities anchored in multilateral institutions. So to conclude, one last banknote. In 1926, the governor of the Bank of England, Montague Norman, helped convince the then Chancellor of the Exchequer, Winston Churchill, to return sterling to its pre-war parity with gold. This was a decision that plunged the UK into deflation and deep recession. The old policy, as it was known, was not well suited to the new post-war normal, and by the time the UK abruptly abandoned it in 1931, unemployment had doubled to 15%, and the economy hadn't grown since the policy was readopted. Today, after another crisis, the choice isn't whether or not to peg the currency, but the stakes are nearly as high. The world's changing rapidly. It's less hegemonic and more multipolar, less analog and more digital, less destructive and more sustainable, less centralized and more dispersed, less bank and more market. The old normal of cash, bank-based finance, and bank payments rails is crumbling. And with a palette that includes a new form of public money linked to a plethora of new dispersed private networks, central banks can paint a new finance that will make payments significantly cheaper and faster, a new finance that can create new forms of ownership and asset classes, power contingent payments and distributed finance, and integrate decentralized networks that help track and reduce carbon emissions. By being resilient, dynamic, inclusive, and sustainable in these ways, the new art of money can serve everyone across this new world. And with that, thank you very much for your attention. I look forward to my colleagues' comments.
Thank you very much, Mark, for this very, very rich and artistic, thought-provoking perspective. Now let me turn to the panelists. I will call them on alphabetical order of their country. Therefore, we will start first with Ignacio Visco. So Ignacio, the floor is yours, please.
Thank you for the kind invitation, and really I'd like to congratulate Mark for providing, as usual, a very insightful perspective on a key question for the future of all of us and the future of central banks. I like to start with a quote, and the quote is the following: "Looking to the next few decades, technological advances combined with fairly dramatic economic and social changes could create conditions for the emergence of new virtual forms of money." I don't know whether I started my video. Okay, new virtual forms of money and credit. On the positive side, these digital forms of money could help to create more efficient and more global economies and societies. On the negative side, tomorrow's new forms of money could make it easier to engage in anti-competitive behavior, exacerbate exclusion and inequality, foster economic volatility, facilitate criminal activity, and even undermine the effectiveness of macroeconomic policy. These are not sentences written a few years ago, when we started to give special attention to the development of instruments such as crypto assets, stable coins, and central bank digital currency. It is the opening of the foreword to a book titled "The Future of Money," published in 2002, which brought together a series of papers presented at an OECD Forum for the Future meeting held in Luxembourg exactly 20 years ago. In all honesty, as the OECD chief economist, back then I was more concerned with the pressing conjunctural and structural economic and policy problems that we were facing at the time, globally and within the OECD member countries. In the economics department, longer-term issues such as those implied by aging societies or global warming were obviously examined in depth and discussed in our policy fora, as were the implications of globalization and ICT revolution for our economies and our societies. However, we still consider the future of money too distant to be of major concern. we gladly left it to a small advisory unit to the Secretary General that organized within the OECD discussions with experts and policymakers on longer-term economic, social, and technological developments and their consequences for policymaking. Rereading that book today, with the benefit of insight, three issues in particular stand out as the most striking. First, a prediction was made with absolute certainty that money's destiny is to become digital. It is worth noting that although 2001 is certainly not that far in the past, at the time Facebook did not exist. Apple had yet to introduce its first smartphone. Google was still an infant company, and Amazon, despite being 7 years old, was far from being the giant tech company it is today. Therefore, even though the necessary technology was not yet in place, the prediction was made based simply on the consideration that the long-term evolution of money had been, for centuries, one of ever greater abstraction, along a trend of increased disassociation from a precise physical materialization, one that digitalization would make final. Second, the costs for consumers of not having a digital money were considered at length. They included not only the traditional ones related to the handling of physical cash, but also others. For example, the impossibility of obtaining discounts on cash payments as a consequence of the contracts between merchants and credit card companies, or the absence of those innovations and new startup firms that would be encouraged by digital money. In particular, the availability of a digital money was seen as an especially effective way of reducing the very high costs of remittances and of counteracting the cost of financial exclusion, for example, for those who do not have a bank account. The book therefore very forcefully called on public authorities to introduce digital money as soon as technologically possible. Third, the risks of the possible disintermediation of the banking system were not elaborated on, nor was the consequential diminished role of banks in providing credit to the economy, given the possibility for the public to open a deposit at central banks. The potential loss of effectiveness of monetary policy, which may be due to the diffusion of alternative private digital money, was also not greatly considered, even if it was strongly argued that any extreme decentralization of payments was a no-goer. In fact, it was predicted that whatever form decentralization of payments may take, the control of money will remain in the hands of central banks. That was a quote. The risks of bank disintermediation and the challenges for monetary policy are, however, not only central to today's analysis, but have been discussed at length in the past. Economic historians and central banks have extensively examined the relationship between public and private money. For example, in Marcello De Cecco's book on Money and Empire, a 1975 book, we read of the substantial efforts of English banks to prevent the Bank of England from collecting deposits during the 19th century. On the other hand, in 1999, at the Jackson Hole Symposium held by the Federal Reserve Bank of Kansas City, I remember that discussing all the new challenges for central banks, Mervyn King speculated that in a world of electronic transactions in real time, without the centralization of settlements, and I quote, central banking in their present form would no longer exist, nor would money. Even more than the end of money, the consequence would have been the potential end of monetary policy, with the return to a pure exchange economy or the loss of central banks' monopolistic supply of base money that technology would have made possible. But the importance of centralized systems built around an outside money issued by the central bank, which preserves its value and acts as a lender of last resort, and an inside money issued by the banking system in connection with its role of maturity transformation, has emerged forcefully during the pandemic. I would therefore like to focus on three questions. One striking feature of the pandemic crisis is that banks, thanks to the progress made after the global financial crisis, have been an important stabilization factor. Thank you, Mark. In many countries, For example, the banking system has been the vehicle through which government support measures such as guarantees and moratoria have reached households and businesses. On the other hand, some types of money market mutual funds have experienced severe problems. They require the central bank to step in and are now under scrutiny. Would similar problems have also emerged for providers of private money-like assets? Even more striking has been the importance of monetary policy. Not only have prompt and exceptional liquidity provisions preserved accommodative financial conditions, consequently preventing a generalized tightening of credit and averting the risk of a spiraling crisis, but also the measures enacted by central banks have allowed governments to access the financial resources needed to support households and firms without market tensions emerging. Absent a monetary authority, would issuers of stable coins have been able to maintain the stability of the financial system? The answer is clearly no, as Mark has just told us. And would they have been able to preserve the value of their currencies in both normal times and during a crisis? A third fundamental question concerns inflation. Central banks have guaranteed price stability for many decades. Even during the pandemic crisis, despite consumer price changes having flirted with deflation in recent years, as well as the fact that in the euro area, we are still struggling to bring inflation back to our medium-term target. Our monopoly power over the supply of base money and our credibility have been key in this respect. But what would happen to inflation in an economy in which there is wide circulation of private money beyond the control of central banks? For example, due to a significant presence of digital currencies denominated in a foreign currency or in a basket of different currencies. And we are now quite close to where 2 decades ago the OECD expected us to be, as money appears inevitably to be becoming digital. And central banks and other public authorities alike are asking themselves the aforementioned questions, attempting to govern the opportunities and risks arising from digital money by adopting new regulations and new approaches. In Europe, the European Commission is drafting a new directive to regulate issuers and service providers of crypto assets, while the European Central Bank is currently considering the possibility of starting a formal investigation phase on a digital euro. As a matter of fact, we are rather advanced in that. Similar initiatives are ongoing in most other jurisdictions. Most of the monetary authorities around the world are working today on the possible development of a central bank digital currency, ranging from mere conceptual research to preliminary experiments, proofs of concept, or pilot projects. I'd like to conclude. In 1999, in a speech on Hayek and currency competition, Ottmar Hissing asserted that money is like a language, a convention that facilitates the interaction among individuals when they produce, trade, and consume. As money becomes digital, a new monetary language will gradually emerge, and international coordination will be essential so that, as we do today, we can all continue to speak a common language. But money is not just a language. It is also substance. Its key ingredient is trust. Preserving it in a world that, as Mark Carney clearly described, is becoming more decentralized and polarized, must therefore be our pole star when we regulate private forms of money or design a new digital outside money. This is why this year, under the Italian presidency, the G20 will continue to consider the technological, economic, legal, regulatory, and oversight issues related to global stablecoins, as well as the potential benefits and risks from central bank digital currencies, also in relation to their possible cross-border use, to which Mark has made reference to. The close interrelation between stablecoins and central bank digital currencies, due to their common transactional and store of value purposes, which are such that they may either complement or replace each other, warrant the importance placed on maintaining a holistic view of the payment sector. The late Curzio Giannini, my former colleague and author of one of the most insightful books on the history of central banks, argued that in the case of money, the definition moves around the concept of payment technology, the set of conventions, objects, and procedures that make possible the extinction of the relevant obligations of the exchange activity, end of quote. We need to keep proceeding carefully with the examination of these conventions, objects, and procedures in line with our mandates of price stability and as guardians of the currency. After all, physical, electronic, or virtual, the efficiency and stability of what we call fiduciary money is ultimately dependent, as Mark pointed out, on trust, on confidence. And confidence indeed shares the same etymological root with fiduciary. This is ultimately what we have to preserve. Thank you.
Thank you. Thank you very much, Ignacio, for this very substantive comment. Now, let me give the floor to Elvira Nabiulina, Governor of the Bank of Russia. Elvira, please, the floor is yours.
Thank you. Thank you for the invitation. Mark touched the core issues of monetary system development. And I strongly agree with Mark's main point that digital technologies will have a profound effect on monetary system. New types of money will appear. In order to prevent such problem as fragmentation of monetary systems and in the extreme competition between private and public money, central banks need to both design appropriate regulation and build necessary infrastructures. International cooperation between central banks, particularly in the area of connectivity and compatibility of infrastructures, is essential in this new emerging world. Mark rightly points out that digital money, which we currently observe, often unbundle means of payments function of money from its function as store of value. I would like to stress another feature of digital money, the ability to bundle means of payments function with other digital services. Digital payment systems are typically platforms, so they have network effects. As other platform types of services, digital payments can be a part of ecosystems, which also have economies of scope effect. Within ecosystems, digital payments are bundled with other services. That is, they can be the only means of payments which can be used to buy services, goods from a particular ecosystem. Therefore, such money become super money that are more valuable for customers than other money, fiat or digital. Let me illustrate the consequences of this using a Russian example. Normally, when we think about digital payments, we are imagining big tech companies, say Ant Financial or Facebook, providing payment services or creating stable coins for their customers. In Russia, we see something different, the ongoing transformation of large local banks into ecosystems. Although unique for the moment, our experience may be relevant for other emerging countries with weaker antitrust regulation or those where governments attempt to support national champions to prevent dominance of foreign ecosystems. This experience also may have some relevance for advanced economies where banks may build alliances with big techs. In essence, fiat money issued by bank-centered ecosystem are like stable coins. Indeed, they are fully backed by central banks and do not need any underlying liquid asset to prove their value. Therefore, banks do not need to issue stable coins. They already have them. Banks have just to comply with the banking regulation. Moreover, tokenization of this money could further increase their perceived value for users. For instance, by adding smart contract features and ring-fence them from other fiat money. Banks which build ecosystems around their payment platforms get additional comparative advantages over other banks. They get cheaper funding and more customs data. Customers tend to increase their cash balances in such banks. Therefore, banks may attract more consumers, offering them smaller deposit rates, if any. They can also use unique payment and other client information for better assessment of client credit risks. In the end, credits to customers with lower default risk in such banks get cheaper than in other banks, both because of low cost of funding and better opportunities for client risk assessment. As a result, bank-centered ecosystems receive higher earnings per client than other banks. Due to network effects, the earnings gap can become significant. Effectively, bank-centered ecosystems crowd out other commercial banks from the market, hindering competition and becoming monopolies. Other banks are forced to take higher risks, which may lead to financial stability problems. Since bank-centered ecosystems are usually too big to fail and bear minimum credit risks, they can even start competing with fiat money. The unified payment space may become fragmented and impaired, especially if bank-centered ecosystems issue stablecoins, segregating their circulation from fiat money. Monetary policy transmission might also weaken in such market structures as a result. Financial stability, including those originating from cyber and operational risk, also go up. In principle, antitrust policies could be employed to regulate bank and big tech ecosystems. However, in many emerging markets, antitrust regulation is weaker than in advanced economies. Moreover, as I already said, governments may have incentive to nurse national champions to prevent foreign big tech dominance. Additionally, from theoretical point of view, antitrust may not always be the best instrument because it can destroy ecosystem value for customers by undermining positive network effects and economies of scale and scope. Thus, an important yet difficult task is to secure a right balance between positive and negative externalities of bank-centered and big tech-centered ecosystems for the society. In this respect, for the Bank of Russia, it was essential to create an efficient, fast payment system to support the growing public demand for digital payments and prevent the monopolization of this service by a large bank. First results are encouraging. We observe a fast rollout of the fast payment system that requires only recipient's phone number as an entry and is operational 24/7. However, fast payment systems may not be enough. We can see the CBDC as the next step in our financial innovations. We expect that digital ruble that we work on will provide broader digital payment services to households and businesses. They will be programmable as other form of digital money. Therefore, we will be able to require ecosystems of all types to accept CBDC on their platform, which will not only restore competition, but also decrease financial stability risks of new forms of money. So I would argue that central banks' payment initiatives, such as fast payment system and potentially CBDC, reduce the market power of large bank-centered ecosystems, equaling the level playing field while spreading the network effects of ecosystems to the whole financial industry. Banks and big techs would get more incentives to build open ecosystems. Competition on the credit market would also improve while financial stability risks decline. Other measures such as open banking could further equal the level playing field. At the same time, we do not want to crowd out banks from their traditional business. Thus, our future CBDC will not pay interest on balances in digital wallets. In addition, let me also provide a few comments on Mark's valuable point about international ramification of new forms of money. Cross-border payments in digital currencies are especially important for emerging market economy central banks. The entrance of global stable coins to emerging market economies may increase currency substitution, crowding out local fiat currencies. As a result, financial stability risks may increase while monetary transmission mechanism may weaken. Once again, if stable coins are a part of larger ecosystems, it only complicates the matter because of bundling effect. Faster, easier, and cheaper transfers in CBDC can partially decrease such risks, but would unlikely eliminate them. Not all countries, including Russia, are sure yet that it makes sense to allow big tech companies provide payment services in stable coins to local customers. But if they are allowed, big techs should be required to accept payments in local CBDCs. Stablecoin issuers could be additionally required to issue stablecoins linked to local fiat currency. Such requirements could be especially essential for some emerging market economies with depressed level of trust in local currency. Such local currency linked stablecoins should be regulated by the same rules as other stablecoins. Such rules may include incentives to limit provision of stablecoins in foreign currencies to local citizens. The ability of customers to make international payments within big tech ecosystems with local currency linked stablecoins and local CBDCs would not only minimize technological risks, but also limit the risks of big techs to build closed ecosystems, which damage competition on their product markets. This is why the work of the BIS Innovation Hub on international payments in CBDC is so essential for financial stability in the emerging global monetary system. And to conclude, I will also use this citation. I'd like to recall a collection of essays published in 1932 by Ralph Twotier. The collection shares the title of today's Mark's lecture, The Art of Central Banking. Twotier was an influential monetary economist of the day. The book's preface says, the more intricate the subject, the more inadequate and indeed misleading is the empiricism, which evolves practical precepts haphazard from the superficial uniformities of the past. It goes without saying that this observation is fully applicable to the subject of our today's discussion. Many thanks to Mark and other participants for exposing the intricacies of the topic so that we avoid those haphazard precepts. I'll stop here. Thank you.
Thank you very much, Elvira, for your very, very rich commentary. Now let me give the floor to Ravi Menon, Managing Director of the Monetary Authority of Singapore. Ravi, the floor is yours.
Thank you for the opportunity to engage on Mark Carney's very deeply thoughtful lecture. Mark has given us a powerful rendition of the transformation taking place that will rewire our monetary and financial systems. Centrifugal forces are driving financial functions away from the traditional core. And these forces are not just affecting money, but all aspects of the monetary system. Mark also reminds us that amid this transformation, money has to be anchored on, and I quote, values of trust, resilience, dynamism, solidarity, and sustainability, unquote. I cannot agree more. I'd like to focus on the decentralization of finance across the 3 I's of the monetary stack: intermediaries, infrastructure, and instruments, and how central banks and regulators can potentially shape this decentralization in a way that upholds the critical values of money that Mark has highlighted. Let me begin with intermediaries at the top of the monetary stack. Here, the delivery of retail financial services is being decentralized, and this is happening in 2 ways. First, finance by non-financial players. There's now a much broader range of non-traditional and, unfortunately, often unregulated intermediaries in the retail finance space. This is not just big techs, but also fintechs and smaller technology firms. These players provide payments, lending, savings, and investments as complements to their core digital service. By bundling financial and non-financial services, they're able to better meet the needs of customers. Second, embedded finance by financial players. Regulated financial institutions are reinventing their business models and leveraging on technology to connect with customers at more and varied touchpoints. Financial institutions are embedding their offerings in an array of non-bank digital platforms in an attempt to reach new customers at lower acquisition costs. Embedded finance combines the benefits of platform economics with the trust premium that people still place with regulated financial institutions. Central banks and regulators should welcome both these developments. They offer the prospect of more efficient, more affordable, more inclusive financial services. But we need to be alert to new sources of risk. If the distributor and the underlying provider of a financial service is not the same entity, who is accountable to the customer. And as the number of third-party intermediaries involved in a financial services grows, there might also be increased operational risks. So we will need to adapt our regulatory approaches, pay greater attention to market conduct, consumer protection, and technology risks. Regulatory frameworks will need to become more modular and agile. Entity-based regulation remains relevant for the provision of core services such as deposit taking, insurance, and the offer of securities. But for the growing number of players who offer niche financial services, we need to rely increasingly on activity-based regulation. This is all still fairly familiar ground, as the fundamental structure of financial services remains largely intact. Intermediaries continue to be at the center even as distribution becomes more decentralized with diverse players and new ways of connecting with customers. Stepping a layer down, let us now examine the underlying infrastructure of financial services, the second layer. Here, technology is enabling a fundamentally different approach to financial infrastructure compared to the centralized systems of today. Take, for example, open crypto networks, based on self-executing smart contracts and non-custodial financial services, where users maintain control over their assets at all times. By replacing the intermediaries and the central parties, these networks aim to reduce both the cost and risk of finance. By decentralizing key aspects of financial infrastructure, such as access, data, and the code, open crypto networks can also potentially enhance inclusion and innovation. When firms of all sizes and even individuals can directly access financial infrastructure, it could mean more competition and inclusion. When transaction data are available to all participants and not confined within the intermediary responsible for the transaction, as is the case today, it could mean more contestability and transparency. And when code can run directly and publicly on these networks, unlike proprietary code that runs on private servers like today, it could mean more interoperability and innovation. Now, we're certainly not at the point where these self-governing networks can meet the high standards of governance, security, and resilience that we demand of critical infrastructure. Even so, central banks would do well to incorporate these innovations in designing the next generation of payments infrastructure. In fact, these ideas could be particularly relevant to the development of CBDCs. Finally, we turn to the layer at the base of the system, the instruments, or forms of money that should confer the properties of a public good. The decentralization of instruments is most clearly associated with the emergence of alternative currencies to those issued by central banks. Technology firms with large ecosystems, or technology itself, can create new non-fiat currencies. While today's crypto instruments, example like Bitcoin, have failed to become money, we should not discount the possibility of better algorithms leading to viable cryptocurrencies as a global medium of exchange in the future. But the widespread use of private cryptocurrencies could lead to an erosion of the nation-state's monetary sovereignty. And this will in turn have implications for central banks' ability to safeguard financial stability. As Mark points out, the continued centrality of public money in the financial system is key to safeguarding the soundness and stability of all money in the economy. And a precondition for this is that state-issued currency remains the domestic economy's predominant unit of account. The currencies of small open economies may be particularly vulnerable to loss of monetary sovereignty. They do not have the global network effects that currencies of larger nations enjoy. Marcus Brunner-Meyer and others have highlighted the possibility of digital currency areas that transcend national borders with even larger and more powerful network effects. Now, currency competition is not a challenge that we are unfamiliar with. Small open economies in particular have always needed to keep their currencies relevant domestically to preserve monetary autonomy. The benefits of an independent monetary policy have to be weighed against the efficiency gains from adopting a more widely used currency. Pegging to the US dollar, the euro, or even a synthetic hegemonic currency is one thing. But losing monetary sovereignty to a currency that is a liability of a private entity is quite another. To sum up, money must ultimately be trusted if it is to fulfill its function in the economy, as so many of the other panelists have noted. As public institutions which have built up credibility over time, central banks are best placed to safeguard the trust that underpins sound money and safe payments. This trust is not just about money that is safe, but also about a monetary system that is dynamic and purposeful. As Mark has emphasized, it must continually improve how it serves the people who depend on it daily. The key question on the future of money is this: what is the appropriate division of labor between the public and private sector? There is a continuum that spans at one extreme a completely centralized system where there's only central bank money, and at the other extreme a decentralized system where there are only private monies in circulation. Each country will have to choose different positions along the continuum, given its own cultural norms, social compact, and institutional structure. As Stefan Engwes once told me, ultimately it's not even a monetary question, but a political one. For whatever we decide, it must have the consent of the people. The future of money is too important a matter to be left entirely to central bankers. Thank you.
Thank you very much, Ravi. As always, a very well structured, enlightening intervention. And last but not least, let me now give the floor to John Williams. John, the floor is yours.
Thank you, Agustín, and thank you for this opportunity to comment on this wide-ranging and thought-provoking speech. Now, one of the challenges of going last, and especially after just listening to Ravi, really did a great summary at the end, and something I've lived with all of my life, either based on when we use alphabetical order to choose the order of speakers, either because of my last name or in this case, the country name, is that so much has already been said, both by Mark and my distinguished colleagues. So I'll keep my remarks pretty brief. The main premise of Mark's speech is that technology is, and indeed should, transform money and payments. And the central banks must play a critical role in this transformation in shaping the new frontier in money. Now, he identifies key principles for central banking and the provision of money. And it's this connection between the provision and access of central bank money and innovative approaches to finance and financial services that demands that central banks and governments actively engage in these issues. And time is of the essence. This is a subject I'll return to. Issues like access to central bank accounts, regulation and supervision, the potential role for central banks in the provision of digital currencies, these all need to be front and center on everyone's minds. Now, Mark's speech covers a wide range of issues and topics. I'm going to limit my comments to two themes. First is this important in recognizing the speed by which disruptive technologies transform industries. And second, highlight, as my colleagues did, some key policy questions that Mark brought up that new technologies raise and that lie at the heart of central banking. And I should give the standard Fed disclaimer that everything I say reflects my own views and not necessarily those of the Federal Open Market Committee or anyone else in the Federal Reserve System. Okay, so it's important that we keep in mind the speed and range of disruptive technology just from examples that we've seen over the past decades. Experience shows that established industries are most vulnerable. We saw this with taxis, we saw it in retail, we saw it in music. People kind of forget that happened a while ago, but that transformed that. And we're seeing it in film and TV today, and we're seeing it in the auto industry. So there's lots of examples of how quickly industries that have been around for 50 or 100 or more years that were profitable and successful by many metrics saw really rapid and disruptive transformation in a matter of years. Now, new entrants in those industries have taken advantage of gaps in regulations, tax avoidance, and lacks in competing oversight by different entities, both domestically and internationally. Now, admittedly, this isn't all cases, but it is true that existing regulations and policies can be out of date and ill-suited for cutting-edge innovation, as we saw in some of the examples I just mentioned. That said, history teaches us that disruptors will seek out and exploit opportunities like this. Indeed, I've just noted the new argument that the right to free speech is claimed to limit regulation of some types of financial innovation. So when I think about how quickly and how transformative these developments are, especially with new money-like products and services. There's a strong incentive to move quickly here. Senior age, data agglomeration, network effects, and market power are all providing strong incentives for people for enter into these areas. So I'll just bring up three questions. They've been mentioned, I think, by Mark and others already, but I do think these are some of the open questions, at least from my perspective. The first one is something I think Mark takes as given, but I'm still thinking of as a question. And the question is disintermediation or the unbundling of maturity, liquidity, and credit transformation, are these inherent features of new technologies, or is it a consequence of primarily regulatory arbitrage and gaps? So that is, does technology overcome the economics that support the synergies between deposit taking and other activities like maturity, liquidity, and credit transformation that have shaped banking for over a century? So new technology-based entrants consistently tell me that they don't want to get into banking or banking-like activities. And I always ask them why not, given that there's a lot of advantages if you're taking deposits to do things like maturity transformation. Of course, the answer I always hear after quizzing them is, well, I don't want to be regulated by you. So I think we do need to ask ourselves to what extent is it the economics or regulatory issues that are really shaping some of the decisions. And second is, if Mark's right, and if critical functions of financial system are being unbundled, what's the appropriate regulatory approach regarding activities and institutions? And I think this is closely related to the first question. What are the economics and public policy issues that are really behind the new technology? And one thing that everyone tells me everyone says they want a level playing field. But of course, the real issue is not just having a level playing field. That's a necessary condition. But what playing field should be built? And Mark, I think, correctly points out that a lot of the innovation is really moving us into the market-based part of the financial system. And we know, of course, that there are distinctions between banking and non-bank financial intermediation already in our system and the regulations. And thinking about if technology is moving us to more of a non-banking financial intermediation, what's the appropriate regulatory approach? And third, how will I go back to the beginnings of central banking? So one of the things that's great about discussing a paper like this is it does make you, as Mark did, and as my colleagues did, read history and look back at how people viewed this in the previous century and before. And I go back to the issue of why central banks were created, and that was of making sure that there's deep pools of liquidity. And how do these new innovations in money and finance, how do they affect the fragmentation of liquidity in markets, fragmentation of liquidity, or drying up of liquidity in general? And this is at the heart of why central banks were created. It's critically important for financial stability, as others mentioned. And how does one apply Badgett's dictum that Mark mentioned, to lend freely on good collateral at a penalty rate in a world of new finance and new money? We already know that some capital market structures, such as money market mutual funds, open-ended bond funds, and even treasury markets can experience an evaporation of liquidity when under stress, and that some of the structures that people look to in capital markets that provide liquidity in normal times, may disappear during periods of stress. Now, I have a final question, and I know this is a kind of a question that you would ask from the U.S., and maybe my colleagues won't immediately go to this. But where does all the cash go? So unlike many jurisdictions, demand for U.S. dollars in paper currency is growing at a rapid rate and has for over a decade. One question I typically ask people is how much U.S. currency is outstanding, and almost everyone underestimates that. Currently, $2.2 trillion of U.S. dollars, or its paper currency, are circulating, and that number has more than doubled in the past decade. So, thinking about that demand and growing demand for paper currency, how do you see the new technological solutions to money-like instruments replacing paper money that's primarily held not for payments anymore, but for a store of value? So these are just some of the questions that I came away with after reading Mark's really interesting paper. Thank you.
Thank you very much, John, and in particular for asking these very, very interesting questions. So at this stage, I would like to give Mark 8 to 10 minutes to react to our panelists' interventions. And then we can devote the last 15 minutes to some questions that might come from the floor. So Mark, please, the floor is yours.
Wow. Well, thank you, Agustín, and thank you, colleagues, for very insightful comments and being reminded by readings of history and titles of historical works on money that they're trying to distinguish between what's new under the sun, what's being replayed. And Elvira reminded the art of money, the language of money, the various ways of framing these issues. Of course, we're all coming back into the core. I think what I hear consistently is we're coming back into the core of the trust of public money at the core, but then it's the relationship that links that to new forms of private. That's the first thing. I think the second thing that I take is, and this is what I was struggling with or trying to draw out, is to what extent are technological innovations, is this an element of a new private form of money that can be retained and built upon versus another innovation that will fail? And I think the argument is, which I believe most colleagues agreed with either explicitly or implicitly, is that there is something sufficiently new here that it gets into, in fact, in some respects could be substantially, if not quantum new, if I can put it that way, that this integration matters. I think it's incredibly, the point that, I'm just going through my notes, but that Ravi reminded in terms of the unbundling, but rebundling with different services, incredibly important point. And this becomes a broader issue. I think, Ravi, again, as you summarized, that the future of money is too important for central banks to decide. Like, that is absolutely right. And I tried to draw out elements of that, which was there are certain questions of, we can provide some of the necessary conditions for the relationships, going to our core responsibilities, monetary and financial stability. But because there are privacy issues, because there are network effects and competition issues, and on, that other authorities will have to layer those constraints, which could pull out opportunities that otherwise would be there. I think the question, John, that you raised on, I think is a very important point on regulation. Is this a regulatory arbitrage? I certainly would agree with you that, I mean, you've got a broader data set than I do, but my experience has been this point, which is that, and maybe it's a combination of Ravi's and your point, which is that there's an opportunity to provide a payment service which in and of itself is valuable. And I think we should maybe take a step back, which is, and the BIS makes this point, others have made this point, but if we look at traditional bank payment rails, somewhere in the 50 to 150 basis points of costs, and alternative payment rails that are considerably cheaper just in and of itself. Now we can say there's contestability and ultimately that will be competed away, but there's substantial margin to be gained in and of itself before any additional services are bundled with that means of payment. But there's also the additional services that can importantly be bundled with means of payment. And one finds, I'm trying to think of the right way to put it, different degrees of openness with which that is discussed, maybe is the polite way to put it. In other words, whether there are these mutually reinforcing aspects of the social network and the monetary network, if you follow that language, that's there. But that said, as you said, John, or your challenge, which is, yeah, but there's another service that could be provided, which is credit intermediation. And you have all this information. In fact, you have this information plus. And so why wouldn't you do that yourself, as opposed to, and I tried to make this point in this speech, as opposed to effectively white labeling somebody else and passing on that information either through your own algorithm or just the data with customer permission. And I think the answer is it is regulation, because the sense is now just to follow the thought all the way through, though, the sense is it's regulation that would not restrict itself only to the credit intermediation function. Just like if we had an industrial conglomerate that also had a bank. I mean, there's a lot. I'm thinking back to Canada, for example, which you can no longer do. They used to be allowed to be done, and it didn't end very well, so you're no longer allowed to do that. And so it's that it extends well beyond the ring fence. I suspect that it is that, and I'm not sure that it's necessarily the wrong thing, but I think it's a very important challenge. Vera, I very much agree with this, the substance and the spirits of your comments in multiple ways. One, about the fundamental importance of using this as an opportunity to increase competitive pressure in financial services, to address oligopoly positions that do exist. And you also hit on something which I feel is there, but sometimes gets a little underplayed, which is I leap to new digital currencies, token-based, programmability, new opportunities. But what is underexplored is the programmability and contingent nature of existing commercial bank money. It's just been underexploited. And of course, I mean, that to some degree is the genius of the market. Somebody comes along with a different payment rail and approach and provides services, and then the traditional one responds. But I do very much accept that that is possible. I mean, as you gathered, I was trying to emphasize maybe too many notes in the speech, but one of them with the core of public money. Secondly, and importantly, the knock-on effects in terms of financing. And John, when you started talking about where do all the dollars go, I immediately went to, well, in general equilibrium in financing, of course, all the dollars get recycled, and that's why you end up with market-based financing institutions. But of course, you were literally asking where all the dollars go and the store of value role of cash. And I didn't major on this in the speech, in part because I'm no longer a serving central banker and I don't have to make this point, but maybe I should have, which is, I do think cash will be around for a long period of time. And there's more to that than just saying and reassuring people that you will always have cash as an option. There are whole cohorts of our society who couldn't imagine being without cash, and they deserve access to it. There is also the disciplining element of having cash, and then not unique to, well, it's certainly very much the case for the US, the store of value component of cash and the global aspect of it. I'm afraid I'm not really doing justice to all those comments, but I recognize that actually we only have about 15 minutes left. And maybe, Agustín, what I should do is hand back to you so we can hear from the virtual floor. And I'll pick up anything else just when I get a last chance to speak.
Excellent. Thank you very much, Mark. Now, let me give you the floor to François Villero. Please, François, the floor is yours.
Thank you, Agustín. Thank you, Mark, for this fascinating lecture and fascinating discussion. It was very enlightening, your historical parallel with private banknotes in the 19th century. But could I say that our task is still more difficult than the one of our predecessors? Because probably they had to deal with familiar animals on familiar issues. They had to deal with banks that they used to regulate, they knew very well. And they had to deal on a familiar issue, which was liquidity and financial stability. And we have to deal now with new animals on new issues. New animals, big techs, to put it in a nutshell. We don't know them very well, and they have a spectrum which is much broader than financial activities. And this refers to the debate about should the regulation be activity-based or entity-based, I guess. And we have to deal also on new issues. You are right, we have to deal with liquidity and financial stability as in the past. but you mentioned at least two issues which go beyond finance, which are privacy and competition. I would add a third one, which is cybersecurity, obviously. And here the question comes, who is in charge of this three issue at global level? And the short answer would be nobody at this stage. So how can we deal with this still more important challenge? I will stop there.
Thank you very much, Francois. Is there any other? Let me add one question of myself and try to pick a little bit on your brains, Mark, on this other very important stream of work that you have been doing, which is green aspects. You mentioned that, obviously it's to be seen what will be the shape and form of the new monetary arrangements that we will have. And you talked about the carbon footprint. Have you done any numbers? Do you have any idea? What would you recommend for us to do in that respect? Is there any?
Reza Bakir from Pakistan.
And okay, so why don't you entertain these two questions, and then there is one more question.
Okay. Well, the first thing is, in terms of, I think we should set ourselves a bar. Might expect me to say this, but that the new system is at least as carbon efficient, if not more carbon efficient than the existing system. I don't see why we would, every single sector of the global economy and region is thinking and working and ultimately reducing its absolute emissions, absolute emissions, not just emissions intensities, absolute emissions over time. And I don't know why we would set up the core of the system in a way that is inconsistent. I mean, the easiest thing is in terms of when your carbon footprint reaches the level of countries, fair sized countries. The insanity of that is that's clear. I think we're all aware that there are much more efficient ways of conducting distributed ledger technology, proof of stake, proof of authority. More will come. So that's very promising, and that gets applied. And then, of course, the two-tiered system itself, if that is indeed the system that's adopted, is much more efficient again. Particularly, crossing a series of payments within wallets and then crossing up top. So there is much there. I think the thing I'd like to flag, if I could, a small commercial for the Innovation Hub and some of the work that's being done. And I touched on this a bit, but part of what, let's say, I'll use CBDCs at the core. CBDCs cross a series of platforms with native token applications. One of the biggest ones will be in green electrons, in carbon offsets, and that technology is developing. And I know that Benoit and others are doing some early work. And at the Green Swan conference of a few weeks ago, we started to draw out some of the components of that, and that is a system that then can be linked with value through, I'll call it through a CBDC. You can argue through ultimately a stable coin as well. I think in the end it gets linked through a CBDC. And that is a very, very powerful accelerant or I shouldn't say accelerant, it is an alignment mechanism for decarbonization. So there is a meta point, Agustín, which is around the actual footprint of the system as a whole and measuring and being clear about that. But then there's also how this can link and help accelerate decarbonization. I think last point is, on Francois's point, this activity versus entity based absolutely is the challenge when you think about an entity, within a broader set of entities, and that goes back to John Williams' point on the regulatory arbitrage, or at least my partial response to that. And then those responsibilities for, and Francois, again, rightly, has cybersecurity and the integrity for that. We are partially responsible. I mean, depends on the central bank for the cybersecurity aspect of it in terms of our operational responsibilities, but the privacy and competition element, we're partially, but not totally. And then in terms of privacy and competition, we can help inform, but are not decisive on it. At least that's my perspective, even with respect to competition. So we're working with others, necessary but not sufficient conditions in those regards.
Thank you very much, Mark. We have two last questions. One first from Reza Bakir, Governor of the Central Bank of Pakistan, and the final question will be posed by Benoit Courret. So please, Reza and Benoit, pose your questions, and the final word will go to Mark. Reza, please.
Agustín, thank you very much. And Mark, really enjoyed listening to your lecture. I have a practical question. In Pakistan, as you may know, it's the world's 5th largest country, an emerging market, where one of the biggest challenges we have is low financial inclusion. And recently in Pakistan, the State Bank of Pakistan has been implementing a faster payment system. And that is allowing us now to begin to think about CBDCs, because the IT infrastructure in the payment system is a prerequisite. Now, my question is a very practical one to the panelists, which is that as we consider, and we are at very early stages of thinking about these issues, as we consider CBDCs, and we particularly also want to think of prioritizing the goal of financial inclusion, promoting it, what in your view are shining examples from the emerging market space that we could look at closely? Thank you.
Thank you very much, Reza, and Benoit, please.
Thank you, Agustín. Two points, and first I would like to confirm what Mark said toward the end of his last remark, that once we have a proper way to collect and to process data on carbon footprints, then we can also find a way to channel this data to payment platforms, public or private payment platforms, and to use programmability based on this data. But the first step is to properly collect and process the data, which today we don't do, and that's what the G20 tech sprint that we are doing with the Banca d'Italia is about, as a stepping stone for the whole process. And the second point is a question to Mark, and tell me if I'm wrong, but I sense a kind of a tension in your speech, which is fantastic. But there is a tension between two aspirations. The first aspiration is for the central bank to bring players together and to ensure the singleness of money and the liquidity of money, which is a core condition for it to be used as a unit of account and to be accepted as a means of payment. So the central bank as a convener that brings players together. And on the other hand, there is this aspiration to make use of programmability and to use money to serve different, purposes, different aspirations in different parts of society. And there is a little bit of a tension there.
Thank you, Benoit. And before I give you the floor, Mark, Ignacio wants to come back quickly. Ignacio, the floor is yours.
I just wanted to say a word on financial inclusion, because that was a question, whether we are discussing this. Indeed, in the G20, we are advanced in what is called the Global Partnership for Financial Inclusion, which is co-chaired by Russia and Italy. And we have been discussing this, the main point being the risk of digital divides. There are a lot of opportunities, but there are risks linked to not only financial education not being somehow not uniform, but also uneven, but also digital education. And this is one issue that we have been discussing. The other has to do with the infrastructures. Basically, the availability of a level playing field, if you want, in terms of infrastructure is not there. There is much that has to be done. Also, with respect to the issues like the ones that Ravi pointed out about the third-party providers and all these. I mean, there are a number of issues that require international cooperation, and not limited to central banks, but which have to include other authorities, be those privacy or electricity providers and the authorities that somehow supervise them, or antitrust and so on. So, but we are very much engaged in that, and really recognize that this is an issue which is closely linked to digitization. Thank you.
Thank you, Ignacio. Mark, the last 5 minutes are yours to wrap up.
Okay. Well, the first, Reza, I may not be best placed of the colleagues to answer your question, and I take what Ignacio just said in the initiatives of the G20. I do think your neighbor, the Aadhaar system, their elements. I mean, one of the core things, as you know well, in terms of inclusion, and sometimes there is we merge a little too readily new money, new payment system, financial inclusion, when a large element of this is the digital ID component of it, which we all have. There's history. I'm giving this lecture from the UK, where there's a long history around IDs and just personal IDs, let alone digital IDs. And so, we all have our own constraints or history around that. But you can go a long way with a digital ID. Let's put it that way. Sometimes the money is almost the back door into that digital ID. So the Aadhaar system, the India stack, I note that, but I'm not telling you anything you don't know in that regard. I'm just giving my perspective. Benoit, as usual, puts his finger on something at the heart. So there is this tension to establish the substitutability, the uniformity, the cross-referencing with the public money, but then there are elements of segmentation, right? There is let's imagine a world where here's the central bank digital currency cash component, the digital cash that ring-fenced. Fabio Panetta talked of 300 euros or so the other day, or at least I read that. Well, how do you carve that out? Well, there is a constraint or some sort of programmed element. There's a certain amount that runs through a network that has a quote smart contract, but is effectively a contingent payment. Therefore, there's a segmentation there. There's other sweeps potentially in terms of what is used as payment as opposed to what is being used as store of value. I'm saying apart from cash, but as store of value under stress. And you see these these potential overlays, so it can get fairly complicated fairly quickly. I don't know more than to make those observations, and these are some of the challenges that you're working through. And maybe I'll just, with my last 30 seconds, minute, just say, as a now outsider, how impressed and I am and pleased at all the progress that you individually and collectively are making around these issues. They are incredibly challenging. They have huge promise, and sometimes they're conflating of various things, but still they have huge promise, and there's an opportunity to build a new system that really serves the public much better. As always, when there's big change, there's risks that come with it, and your roles are very much to think through those risks and to appropriately mitigate them while unleashing this benefit. But it's very impressive what's been accomplished in a limited period of time. And maybe I'll conclude. I know you weren't saying this, but it's a good challenge, Ignacio. It's not, it doesn't feel like 2002 Redux. It's one of those. It's come back in a way. Things have come back in a way at a time where the economics, the technology, the underlying drivers are fundamentally different. It feels more like, and I think John's caution there about, well, gee, the music industry didn't. I mean, we don't even talk about the music industry being disrupted. It was so disrupted. I use Uber as an example because it's relatively recent. You see it in satellites. You see it everywhere. And so why wouldn't we ultimately see it in money? But the important thing is to channel it so that people are better off, and we keep the core of the system because you don't know what you have till it's gone, and people will really know it's not there, and then we lose that consent. And I was pleased to hear Ravi and others using and underscoring consent. So with your consent, I will now be quiet, Agustín, hand it back to you, and thank you for the privilege of being here. And I'm looking forward to that. It doesn't have to be a go. We just need to get together at some point. That would be fun, whatever the reason.
Excellent. Well, we'll make it happen. In any case, thank you, Mark, very, very much for this very inspiring lecture, challenging lecture. I think that you are challenging us with your thoughts, and they come with the added benefit that you combine perfectly your legacy of central bank with your insights of being a very open mind and reflecting that in your presentation. I also would like to thank the panelists for great discussion, for great interventions, very thoughtful, all of them. And thank you also for the questions from the floor and for all of you attending this meeting virtually. Hopefully, we will convene again for this type of conferences in person here in Basel. In any case, in the meantime, I wish you all the best and stay safe. Thank you all very much. Bye-bye.
Bye-bye. Thank you, everyone.